We just finished going through Microsoft's FY26 Q4 earnings call materials, and now we want to share our takeaways with everyone. Here's the question you're already asking, and I've been sitting with it half the night. If you spend $41 billion in a single quarter, what exactly are you getting back? Goldman Sachs asked the CFO that, straight up. And the answer was, I don't think my math has changed over the past year. That's it. No number. So that's what we're taking apart tonight, a company that told us everything except the one thing we asked. Start with what the company reported because the top of this business is genuinely extraordinary. FY26 revenue of $331 billion, up 18%, and the company calls that accelerated growth, not just growth. At that scale, acceleration shouldn't really be possible. A business this big is supposed to slow down. Operating income of $155 billion, up 21%, which means profit is growing faster than revenue. And then there's the other side of it, Q4 capital expenditure of $41 billion, with free cash flow compressed all the way down to $19.6 billion. When Goldman Sachs asked how the return on that capital compares to a year ago, the report shows the CFO answered, I don't think my math has changed over the past year. No specific ROI numbers were provided. Our take, and I want to be careful here, silence isn't evidence of a problem. It's the absence of evidence, and that's a different kind of uncomfortable. The company frames the whole business as 3 pillars, and honestly, that framing does a lot of work. Intelligent Cloud, $39.3 billion, up 32%, with Azure up 43%, and this is the most capital-hungry piece, the one selling the shovels. Productivity and business processes, $37.8 billion, up 14%, carrying a 58% operating margin. Pay attention to that 58% because the company describes this segment as the engine funding the AI arms race. Office pays for the GPUs. Somebody's boring spreadsheet software is financing a gigawatt of data centers. Then more personal computing, $12.9 billion, down 4%, and the company flags it as the only segment in contraction. Windows, Xbox Search, the foundation this entire company was built on, and it's the one piece going backwards. I'll read, this isn't 3 businesses, it's one cash machine funding one moonshot, while a third one quietly decays. Now let's clean the quarter up because the reported number has noise in both directions. The company reports Q4 earnings per share of 4.704. Strip out a $3.2 billion one-time gain tied to Anthropic, then add back the Xbox severance and impairment charges. What's left is about 23% true operational growth, and that's the number I'd actually put in a model. Operating cash flow of $55.4 billion, up 30% with an operating margin of 45%. That still ticked up year over year despite all that capital spending. And here's the line most people will skip straight past. Total employees down 2% while operating income climbed 21%. The company states plainly that operating leverage is not solely an AI phenomenon and that aggressive human capital restructuring is actively driving those margins. Our take, part of this margin story is software eating work, and part of it is fewer people doing the work, and you should count both of those honestly. This one reframes everything, and I don't think the market has fully absorbed it yet. Azure grew 43% in the quarter, with roughly 45% guided for Q1. Normally you'd read a number like that as a demand signal, customers wanting more and buying more. The company says that's wrong. Demand isn't the constraint. Power is, racks are, chips are, and construction crews are. The CFO's admission is the part that matters because of the supply and demand imbalance. Any efficiency improvement gets monetized inside the same quarter. Translate that into plain English. If they find a way to squeeze more out of a data center on Monday, it's sold by Friday. So the company's own takeaway is that Azure's upside and downside are tethered to supply chain execution, to dock, to lifetimes, not to enterprise IT budgets. I'll read, you're not modeling a software business anymore. You're modeling a construction schedule, and those two things fail in completely different ways. Here's the data that changed my mind on Copilot, and I'll own it, I was a skeptic on this for 2 solid years. The company reports total paid seats above 30 million, with net additions doubling quarter over quarter. Clients running more than $50 seats increased 7 times year over year, and the deployments they name are enormous. NAS England at 505,000 seats saving 43 minutes a day, KPMG at 276,000, HSBC at 200,000. But the number that actually matters isn't seats sold, it's the time from deployment to 80% active coverage. And the company says that compressed from months down to days. Daily interactions up nearly 100% year over year, with weekly activity now matching Outlook and Teams. Think about what that comparison means. It's sitting alongside email in somebody's daily routine. Our read seats sold tells you what a company bought, daily dependency tells you what they'll renew, and only the second one compounds. This is the most important structural change in the whole deck, and it cuts both ways. For 30 years, Microsoft's ceiling was the number of employees a customer had per seat pricing, 1 license per human. The company is moving that ceiling to total automatable workloads priced by consumption. The evidence they give is concrete. GitHub's move to consumption billing drove more than 60% quarter-over-quarter revenue growth. Dynamics 365 service token consumption up 4 times in a single quarter, Copilot Cowork transitioning to consumption billing, and security products moving to usage-based tiers. Now here's the trade-off the company states outright, and I respect that they said it. Consumption revenue scales without a ceiling, but cost of goods sold scales right along with it, which permanently changes the gross margin arc. Our take: they just traded a capped business at extraordinary margins for an uncapped business at lower ones. And whether that's a good trade depends entirely on how much lower. Remember that margin problem from a second ago? This is the answer to it. The company lays out a cost waterfall that starts at the baseline cost of running a frontier model on standard GPUs. Step 1, custom silicon, where they say Maya 200 delivers 30% better performance per dollar. Step 2, and this is the big one, route the work to smaller models. The company reports My image cut PowerPoint cost by 84% and My voice cut dynamics cost by 89%. 90% of tasks now go to small models, with frontier models reserved for the top 10%. On the physical side, 31 new data centers in a single quarter, 1 gigawatt of new capacity added, and dock to live time cut in half. The company's own translation is refreshingly blunt. Resilience is the pitch to customers. Margin control is the reality for shareholders. Our red model interchangeability isn't a philosophy, it's a cost lever, and they're pulling it hard because they have to. To be fair, the company has a real point here, and I want to give it fully before I push back on anything. Of that $41 billion in Q4 capital spending, the company says roughly 1/3 goes to land, concrete, and buildings. Those are low reversibility, but the shells can be built, paused, or phased out over time. The other 2/3 goes to GPUs and servers, short lead times, high reversibility. And the company states that spending can be halted immediately if workload demand shifts. They point to 2 more buffers, a geographically distributed client base, and first-party apps like Office and Bing sharing the same capacity pool so utilization gets routed and filled. That is a genuinely well-engineered position, and if the music stops, they can stop buying inside 1 quarter. And here's the bill for that flexibility, which the company itself calls the cost of insurance. Short-duration assets depreciate fast, and the company says that explicitly drags down near-term gross margins and compressed free cash flow to $19.6 billion. Now sit up, because this is the one that could genuinely fool you next year. The company is extending the assumed lifespan on this equipment from 15 years to 25 years, effective FY27. That sounds like a footnote. It isn't. Here's the mechanic they lay out. Extending the lifespan shifts heavy data center leases out of finance leases and into operating leases. And finance leases get counted inside capital expenditure, while operating leases do not. The result the company gives is that projected calendar 2026 capital expenditure mathematically drops to around $175 billion, even though the actual cash commitment to build is identical. Nothing changed except where the number sits. So the rule they hand you for FY27 is that you can no longer judge capital intensity from capital expenditure alone. You have to add the operating lease commitments on top. Our take: this isn't a trick, it's legitimate accounting, but next year the headline CapEx figure is going to look tame when the spending isn't. This is the strongest single piece of evidence in the entire deck, and it takes the bear case head on. Total remaining performance obligations, which is contracted revenue not yet recognized, sits at $678 billion, up 84% year over year. The fear in the market has been that AI money is circular, that big tech funds the startups who then spend it right back on cloud. So here's the company's answer: strip OpenAI out entirely, and the base still grew 25% year over year. They state the sequential growth was driven entirely by non-frontier model clients, and that nearly 90% of FY26 cloud revenue came from those ordinary customers. On timing, weighted average duration is 2.3 years, with about 30% landing in the next 12 months and the other 70% beyond that. And the far-out piece is growing faster, up 112% against 37% for the near-term slice. I'll read: this dismantles the round-tripping worry pretty convincingly, and I'd put myself at 85% that this demand is real and broad. Alright, 3 cracks, and none of them are fatal standing alone. First, the evaded ROI question, because in the middle of hyper, detailed capacity updates, management refused to quantify returns against last year. In a market this sensitive to AI capital returns, that silence is loud. Second, the consumer drag, where more personal computing contracted 4% and management explicitly warned that Windows OEM and devices will see mid-teens percentage declines in FY27. The reasons they give are component pricing and a channel inventory glut, so at least that one is known, guided and quantified. Third, and this is the one I'd rank first, structural margin decay. Company gross margin at 67% and cloud margin at 65% both declined year over year. And the company says the shift toward Azure, the front loading of AI infrastructure, and consumption pricing all guarantee continued margin pressure into FY27. Our take, cracks 1 and 3 are really the same crack seen from two angles, spending enormously and staying vague about what it earns. Let's put the corporate narrative right next to the structural reality, because the gap between them is where the money is. They say demand massively outstrips supply, and they're driving incredible efficiencies to bring capacity online. What that actually means is Azure's growth has become a supply chain execution metric, and it stops telling you anything about enterprise IT demand. They say model interchangeability is a fundamental architectural stance that gives customers control over their intellectual property. So what it really is, by the deck's own reading, is the only viable lever they have to defend gross margins against exploding GPU compute costs. And they say they're an accelerating juggernaut that will keep investing aggressively. The reality is that $41 billion of quarterly capital spending pushed free cash flow down to $19 billion. And the FY27 promise is only that free cash flow will remain positive. For the most profitable software company that has ever existed. Sit with that phrase for a second. I've said it before, what a management team won't answer tells you more than what they will. The report breaks the analyst Q&A down, and the pattern is impossible to miss. 3 separate analysts, Jefferies, Bernstein, and Goldman Sachs, all pushed on AI capacity, CapEx limits, and the return on that capital. What they got back was detailed reversibility explanations and zero quantification of ROI yields. 2 analysts asked about open source versus proprietary models and got strong specific cost saving metric, those 84 to 89% reductions. 1 analyst asked about the pilot to production shift and got overwhelmingly generous seat and usage velocity data. So product metrics flow freely and capital return metrics stay locked in a drawer. The company's own framing calls that asymmetry the most telling data point of the quarter, and I'd agree that's exactly what it is. Here's the honest framing, and the deck deserves credit for putting both sides up without picking one. The bulls would say look at execution, a $331 billion top line that's accelerating, $678 billion in contracted backlog, Copilot scaling into consumption billing, enterprise demand validated. Their conclusion is that Microsoft has definitively won the demand and capacity phases of the AI race, and over a 2-year horizon I think that's simply correct. The bears would push back on a 5-year view, and their metric is margin structure and return on capital. Free cash flow compressed to $19.6 billion, opaque returns on annual investment cycles above $100 billion, and gross margin decay built right into the consumption model. Their conclusion is that the real ROI only gets revealed in the quarter supply finally overtakes demand and prices break. Both of those are mathematically true at the same time, which might be the most useful sentence in this entire deck. Our take: the next 12 months come down to which number leads the story, revenue growth or the slope of gross margin. The company closes with 8 things to track, and I'd split them exactly the way they do. On capital intensity, free cash flow direction has to stay meaningfully positive as capital spending keeps scaling. True investment intensity means CapEx plus operating leases combined, and the FY27 Q1 guide is already above $50 billion. And gross margin slope, which they call the earliest warning sign that AI supply is crossing over demand. On growth quality, Azure has to hit that roughly 45% guide to prove the supply chain is actually executing. Non-OpenAI remaining performance obligations need to hold above a 25% baseline to prove the demand is broad. And Copilot RPU, watching GitHub at plus 60% quarter over quarter, and Dynamics at 4 times token usage for consumption leverage. On risk, the exact depth of that mid-teens Windows OEM decline in FY27 and whether Xbox recovers, which is a binary test of whether this team can execute a turnaround. Alright, last thing, radar always leaves you a light. I'm calling Microsoft yellow. And this is the hardest yellow I've had to write in a long while. The demand is real, the backlog is real, and $678 billion of contracted revenue with OpenAI stripped out is about as close to proof as this industry ever gives you. What stops me is that free cash flow fell to $19.6 billion while capital spending hit $41 billion in a single quarter, and management would not put a number on what that capital earns. And starting FY27, the accounting change means the headline CapEx figure understates the real commitment, so checking their work gets harder, not easier. Here's what flips me to green. One clean quarter where gross margin stops declining year over year, plus any specific return figure at all, even a rough one. What turns this red is gross margin sliding while free cash flow keeps compressing, because that combination is the shape of overbuilding. I'm maybe 60% on this yellow, and I'll say it plainly, I'd rather own this than most things. I just wouldn't pay up for it tonight. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.